allow me to just start over again so that we can have a smooth flow. Right. Okay. So what I was just trying to say is that today's conversation is just to then maybe provide some insights on whether elections really affect GDP growth, that is economic growth. And to my first slide, just to see what really happens in terms of our political environment and even the government policies that are really adopted, and of course, what characterizes an election year. So, and I have said that from our observations, even in other countries, this is not unique to Kenya. It also happens in other countries where we actually see subsidies really extended to the population, just to cushion, of course, like now when the way we are having a high cost of living, we've seen for us, the government has come in to provide oil subsidies, and as you are aware, that is not sustainable into the future because of our position in terms of our revenues. And we've also seen, of course, the sitting government being in a rush to complete projects. That is also, we've seen that also happen in Kenya, and that is happening even in 2022. We have major infrastructural projects that are happening and have to be completed before elections. We also experienced reduced revenues, and this is largely because of a slowdown in economic activity this year. In an election year, in other regions, we've witnessed lower taxes, but from budget highlights, what we have seen is that for us, we have higher taxes in some commodities, and largely driven by prevailing market conditions. We also experience postponed business and regulatory decisions in such a year, and that is what really contributes to the slower economic activity that we witness in an election year. And last but not least, this is a year that we also experience slower credit growth. Private sector credit growth is really affected as well, and we shall see in the later slides whether it's affected just by elections. Is lending activity slower just because of elections, or are there factors that affect that as well? But definitely postponement in, of course, capital expenditures by companies and slowdown in general economic activity has a bearing on lending activity as well. So moving on to the next slide, just to see, to reiterate, or rather to see whether those factors that I have highlighted have some bearing or have had some impact on economic growth in the past election years. I've tried to really map out so that it brings it out clearly. And you can see going as far back as 2002, in election years, just because of the factors that I've mentioned, it's true, we have reduced economic growth. You can see in 2002, where we had, of course, subdued economic activity there. In 2008 as well, we had our elections at the end on 27th December of 2007. So a big portion of that impact was felt in 2008. But we shall delve deeper into the macroeconomics to see whether it was only elections or not. In this particular graph, it's just to see whether then the economic numbers were actually affected in election years. And you can see it was lower in election years. Then we have, because of Kenya's position, Kenya has been a very resilient country, and we normally experience a rebound after those depressed numbers in election years. So we see after the elections, if there is no political instability or post-election violence, then we normally spring back because of business optimism after elections. So I think that is important to note there. Economic growth is actually affected by election years and the decisions that are made in such a year. Then let's look at the macroeconomic environment. When you look at the macroeconomic environment, we have seen a different story here. Starting with the currency trend, in 2007, I've gone as far back as the data that was available. In 2008, 2007, in the run-up to elections, we've actually had the USD changing to Kenya shilling actually strengthen in the run-up to election days. That is in election years. And this has been, just looking at the reasons, going back to those years, just to see then what really drove that kind of a trend in an election year. The reasons or the factors are not the same. It was subject to the prevailing macroeconomic conditions at the time. So that is very key to really note here. The macroeconomic environment, looking at the currency alone, tells a different story. The movements in those years were actually affected by other factors other than elections. So if we look at 2007, remember in 2007, that is when we also had capital inflows. We had our two IPOs, Kengen and I think it was Kengen and Equity Bank. There were a lot of inflows, a lot of interest in our markets as well. Those inflows, of course, told a story, helped to really strengthen our currency during those years. And when you look at 2013, in the run-up to 2013, we also had quite some heightened capital inflows. Remember, we were coming from global financial crisis in 2008. There was a splash of hot money from the developed markets. And in 2013, it didn't really matter whether we were going into an election year or not. There was a bull run, even in our financial markets. Foreigners were here. So capital flows were quite high during that time. Our elections were in the first quarter of 2013. So what we experienced that time is dollar inflows, and of course, looking at also our exports, they were favorable during that time. In 2012, we had favorable weather conditions. All that contributed to the kind of trend that we saw in 2013. Capital inflows were high at the time. Despite even having some sell-off in February there by foreigners, we still had, in terms of capital flows, quite high. Come to 2017, you remember we had oil glut in 2017. That was, of course, of gain when you look at a net importer country for us. Oil prices had started actually weakening in 2017, which was favorable to us and the currency as well. Then, of course, other factors also came into play. In 2017, we still had foreign inflows coming in. Diaspora remittances were actually making sense. They were actually getting to some levels that were near or had surpassed the export earnings that we were also receiving during that time. So again, when you look at currency trends affected by other factors other than just being in an election year. And to our surprise, in the run-up to elections, we had the currency actually strengthen. Then let's look at another factor. That is the inflation trend during election years. Again, when you look at the trend, and I've tried to really highlight just a few, going back to 2008, the factors that played out during that time were quite different from what we saw in later years. So 2008, inflation was quite benign in the run-up to elections. But immediately thereafter, because of economic paralysis that we experienced during that time, we had our headline inflation actually skyrocket to very high levels. Then when you look at 2013 inflation remained quite benign. Actually, it was at, by the time we were going into elections in March, it was at about 4%. Again, favorable food prices coming from 2012 and the policies that had been adopted at the time from the MENA crisis in 2011 really contributed to that kind of movement that we saw in 2013. Then looking at 2017, we had drought during this year. Remember that is the time we also had maize flour really go up, and we also saw food inflation generally really spike during that year. So again, other factors come into play, not just elections in an election year. So that is important to really bring out. Then looking at the private sector credit growth that I had talked about earlier, what have we seen? What kind of trends really play out? And this is very key to us because this is, to some extent, that what stimulates economic activity in our country. So going back to 2007, we have seen that actually lending activity rose pre-election in pre-election periods. When you look at 2008, when you look at 2013, that is what happened. But in 2017, it was a different story. And this is because of the interest capping law that was enacted in I think, third quarter of 2016. So we had already started feeling or getting the effects of that law even into 2017, which was an election year. So we saw actually lending activity decline in 2017. So again, unlike what we have seen in economic growth numbers, macroeconomic indicators tell a different story. So let's look at the effects on our financial markets. And I know this is information that is out there. This is something that has been written even in our newspaper articles and all that. And conversation today is also to see, then with all that we have said, so what for an ordinary Kenyan, and so what for an investor looking into Kenya this year? So let's look at the financial markets. So I'll start with the stock performance, market performance. This is percentage return, percentage performance of the NSE 20 share index. And you can see in 2002, because of the optimism, because of change of regime at the time, there was a lot of course, participation, or rather, there was a lot of demand in our markets that really drove prices up. And that is what speaks into that high return, that spike in terms of percentage return in our stock markets. We actually had a return that has not been seen in percentage terms thereafter. This is 20 years later. So we had 100% return on our markets in 2002. So in the run-up to elections, we actually saw momentum building up in our financial markets, again, because of investor sentiment. Then let's look at 2008. You can see it's a downward trend there. In the run-up to elections in 2007, there was optimism. Again, I talked about the IPOs during that year. And of course, retail investors were big players as well. There was a lot of local participation that drove demand in our markets in 2007. But thereafter, of course, we experienced the effects of the post-election violence. That was in 2008. Then looking at 2013, you can see positive momentum there. The returns were actually positive. And this is because of the foreign participation. The scales were tilting a bit. We were having more foreigners. In fact, foreign holding actually increased during the year between 2011 and 2015. We had holding, that is foreign shareholding, really going up during that time. And we had a bull run that was not even interrupted by the elections in 2013. And that is why we had a positive performance in 2013. Then in 2017, you can see in the run-up to elections, I think here we were suffering from a myriad of factors, one of them being the interest capping law, and of course the investor sentiment coming from that particular law, and the expectation that, of course, the banking sector was going to be affected negatively. So, but that said, again, having two elections in that year did not stop us from actually being voted, from actually recording a very strong performance in 2017, despite being voted the worst in 2017 because of a sell-off after the election results were annulled in August that year. So that is the last time we actually had a very high positive performance in an election year in the last 5 years. So that is something to really take note of. Then let's again continue that conversation on our stock performance, looking at just the foreign exits. Why I have included this slide is because foreigners today, you can see the black line, that is foreign participation. They actually increase the activity that we see in our local markets. And that is why we follow actually what then they do, because their participation has been very high. You can see local participation has been very low, and we need to stimulate that. So we are really dependent on foreigners when you look at the kind of activity that we have in our stock market and the demand therein. But then when we look at the inflows, Do they tell a different story? You look at the green line, the trend is downwards. So from 2013, we've had a downward trend in foreign inflows. Again, driven by a myriad of factors, including policies that have been enacted along the way. And of course, we also had the stimulus package in US being wound up. So that also contributed to lesser inflows into our financial markets. But generally, the trend has been downwards. And when you look at 2019, again, moving away just from the election year, we had that actually go up because the interest capping law was revised, or rather removed in that year. Then, of course, we suffered COVID, and now we are in 2022. And I know the kind of questions that we are asking, what will happen this year? I will speak into that. Let me summarize the stock market with this graph. And you can see the trend from 2013, that is when we were experiencing some very good momentum in our financial markets. From there on, we've had a downward trend in our equity market. That tells a lot, even in terms of the kind of returns we are having for our pension schemes. And you can see it's been really weighed down by quite a number of factors, not just election years. And policy, of course, drought, all that has been driving investor sentiment during this time, and even participation in our markets. So I think that is something that we really need to take note of, and just to see then in our later conversations, what do we then need to do to turn around that story, to have that graph turn into positive, and have many more companies that foreigners can look into, and even locals can buy into in our stock market. We pack that a bit. We look at the debt market. So for this one, it's an obvious story here. We have talked about debt pile in an election year. And for us, it's been more than just the election year, but of course the activities in this year go into definitely building up on the debt pile that we normally get in an election year. So I've gone back to just one election period so that you don't get a bit mixed up here. And just basically the way to interpret this graph, this is the yield curve. It just shows the rates, the bond rates across the different tenors. And you can see in 2017, we had our elections in August. Where were the rates in 2017? Remember, we had high inflation in first quarter of 2017. So we also, of course, experienced high levels of interest rates during that time. So 2017, then look at December 2017. So at the beginning of the year, we had high level of interest rates, but later in the year, in December, they had come off. But then again, that was after the Supreme Court, of course, ruled on the election cases that were there. So we saw rates going up, but they came down. But it was not just because of being in an election year. It was also driven by supply constraints during that time. Then let's look at 2021 into 2022. Today, when you look at where we were in December 2021, that is the blue line, interest rate levels were lower than where we are today, the gold line, if you like, in March. Again, has this been just because of the debt pile? Or are there other factors that have affected that? So this year, we have experienced also a heightened level of uncertainty coming through from external factors, starting with the geopolitical tension that we are currently experiencing. So investors, in addition to, of course, the kind of strain, fiscal pressures that we are having today and reduced revenue, we are actually seeing investors pricing in a very high risk premium when they go to treasury bond auctions. And that is what is actually driving the rates up. The uncertainty also coming through from being in an election year, definitely that also affects investor sentiment. So it's not just being in an election year, other factors also come into play when it comes to the interest rate level in the country. So what are we saying? When you look at the effects of election years on the economy, there is definitely a trend there. We have what we are saying is that the economic activity or economic growth is actually affected in election years because of a slowdown in economic activity. But when we now look at the macroeconomic environment and the financial markets, they are affected by other issues other than elections. So elections just becomes one of the conversations that you will then have in the trends that we have seen. Then to now the year we are in 2022, because all that historical conversation is just to then tell us as investors, as business people, what does the year 2022 hold for us. So definitely we are going to experience reduced growth. But then remember, we are coming from a very high level. The base effects also are going to definitely push the numbers to pre-COVID levels. We are not going to grow at the numbers we saw in 2021. So already the base effects bring that number down. And the other thing is to also recognize 2022 is a different year. It's an unprecedented year. And that is why we really need to have these conversations. We really need to listen to also the technocrats. We need to really be deliberate in these elections. We are already on the ground. We are already on the ground, reeling from, of course, the COVID effects, the pandemic effects. We've been actually on we can say, being really supported by the IMF and World Bank. We have seen a high level of debt pile. Of course, because of, among other issues, infrastructure spending, which has, to me as an investor, has been positive because we have, of course, the road networks, the rail, and ICT infrastructure actually improved in our country. So that has to come at a cost, and the cost is debt, because we don't have a savings culture. And then, of course, we have food insecurity because of the erratic weather conditions. We are still depending on rain-fed agriculture. So again, what we are saying is that this is not 2017, this is not 2008. We are facing a different set of challenges. Then what is the conversation herein? Then this year, 2022, starting the year with that, then we get the Russia-Ukraine invasion. It's an election year. Remember the debt moratorium expired in December. So this year we start, of course, servicing our debt full throttle. And then we have a weakening currency because of what is happening, because of external factors. So that is now, in essence, what takes me to the next slide. As an investment community, we cannot keep quiet. We then need to participate in this conversation on what then needs to happen. We are already on the ground. What needs to happen so that then we can be able to have increased level of revenue. We can be able to meet our financial obligations as a country. And we will speak into the leadership. And we focus on the leadership because that is what sets the tone. And again, we have said we are already on the ground. This is a time where we do not need, we are sort of at crossroads. On one hand, we have debt pile, we have servicing, financial obligations. On this other side, we have a citizen who are quite enterprising. We have infrastructure. Then how do we unlock our full potential so that we can be able to meet our obligations comfortably going forward without depending on other revenue sources? So that is where now this slide takes us. We are saying that the next leadership has to be different. It must be different. It needs to focus on building an efficient government to eradicate corruption. This is not a time, given that we're on the ground, this is not a time we need another corruption scandal because of the kind of debt servicing that we have before us. We're also saying that we need to formulate policies that will actually catapult us, or rather our economy, to the next level. We have all it takes. Kenya is a rich country when you look at the kind of resources that we have. When you look at the labor, it's actually in abundance. So we have everything that it takes to then unlock our full potential as an economy. And this can only be enabled by actually a linkage, for example, of the kind of infrastructure that we have. Can we link that to structural transformation? What do I mean by that? We need to have, of course, we need to move from low productivity to high productivity levels that are actually enabled by skilled intensive labor, moving away from what we've had previously, labor intensive. So, and we have everything that it takes. We've seen the service sector really grow. We have the infrastructure in place. We just need to link that so that we can unlock our full potential. We also need to enact laws that will foster political stability. Again, we put this squarely on the leadership, because when we have political stability in this country, knowing that Kenya has 40 plus tribes, we need to ensure that we have political stability to enable this kind of an environment that we are looking into, stimulate economic activity in this country. For us to go to the next level, we also need social peace. By this I mean you can take care of your population, provide amenities like basic amenities, ensure food security, ensure that there is equality in terms of resources, ensure that basic things like health are really taken care of. We recognize the efforts that have been done by the current government when it comes to, of course, even the kind of changes we have seen, policy changes we've seen in the agricultural sector. We have also seen what they have been trying to do with universal health care. We need that to be built upon so that then we can have that social peace to enable our people concentrate on building up this economy. We need, of course, to formulate policies that will be favorable to the farmers, sound policies that will protect the farmers. You cannot have a population going hungry, and we believe this is the low-hanging fruit for Kenya. We are an agricultural country. We need to move from rain-fed kind of farming to irrigation. We have deserts that are food sufficient. Why is it that Kenya cannot have food security? We are really blessed as an economy, and I feel that it starts with the leadership. Can we go back to that time where the conversation was not about feeding our population because we are subsistent farmers? Then we also need to ensure we have strengthened corporate governance policies and also support our financial markets. And that's where we come in as an investment industry. We have seen the Capital Markets Authority and many other institutions, financial institutions, really participate in this conversation. We have the brains in this country that have actually come up with very good regulations, very good policies to really enhance capital markets deepening. But that is not happening. That is not gaining traction. We've had a lot of products actually being rolled out. We have securities lending and borrowing. We have derivatives market, but they are yet to gain traction. Why is that the case? We need the leadership to actually support the capital markets so that then we can see the foreign inflows coming into this country. We can then stimulate demand from even local investors. You have seen local participation has been very low. We need to stimulate that. We also need to see companies coming onto the stock market to list so that then we can continue with that kind of demand that we would like to see from local participation. That cannot happen if our corporate governance is weak. That needs to be strengthened. So that is enough of the leadership. Allow me to address the business community and the general populace. For a very long time, I think we've seen that we have not fully taken our role. We need the business community to continue in this push towards policy formulation, geared towards, of course, ease of doing business in this country. We have worsened over the years, and this actually needs to be improved. We've seen countries where it only takes 3 hours to set shop as a company. Can we have that? Can we harmonize, for instance, the business permits that we have in this country to enable the entrepreneurs? Those are the guys who will unlock innovation in this country. Can we support entrepreneurs, startups in this country through formulating policies that will enable, of course, our business community? We also need to support, as a business community, support initiatives. We've seen, just because of the geopolitical tension and what is happening in Russia and Ukraine, because of our over-reliance on, like now I was shocked to see our food imports have actually gone up. Our wheat and maize, it's actually gone to another level because our agriculture is rain-fed. So we have now shifted to heavily importing food, like a desert country. That should not happen in Kenya. So what we are then saying is that let us support our own and build our own industries here. We need to buy Kenya, build Kenya. That is one of the initiatives that was actually started to really stimulate demand, or rather improve demand on locally manufactured goods. We also need to enhance corporate governance and ethical business practices, because that is what will attract new money into this country. We need to make sure that we actually, as a business community, in everything that we do, we then lay out, have honest or rather transparent business practices that will definitely woo investors into this country. Otherwise, if we continue on that streak of unethical business practices, then we are not likely to even be able to raise funds in our financial markets. Then we need to keep the leadership in check. This is where the population really comes in. We should not accept what has been going on. We need to really push our leadership. We need to push the political class. Let's push for higher standards of performance and not engage in unsustainable practices that makes you and me rich, but there are millions of people out there who are, of course, languishing in poverty. We also need to maintain peace. You have heard the way we are already on the ground. We do not need any political instability this year, not now more than ever. So we need to maintain peace through shared values. We are different communities, different tribes coming from different ethnic backgrounds and all that, and religious backgrounds. But there is a place for us to also exercise our civic duty to ensure that there is political stability in this country. We need to also maintain positivity. We've seen a lot of depressed people because of the high standards of living. We can only get better. We don't need to push ourselves below the belt. So what we have also done, just to beef up that conversation, is then to see what has happened. We can take a case study of Singapore to actually see, is it really possible to attain this? Is it possible? And a lot of articles, again, have been written towards this. There's a lot of analysis today. But I think it's not rocket science. If it has happened in another jurisdiction, it can happen in Kenya. And it takes leadership. We have seen Singapore, it just took a leader to drive that economy to another level. So what did Singapore do? What were their main drivers of economic success? Singapore, from my research, in terms of land and nature, they have a small area of land. Actually, from what I had seen in my research, is around 728 kilometers square. Okay, that is the area. Compared to Kenya, which is, I think, about 580,000 kilometers square in terms of land size. Okay? Then you move from that reality to another reality. They do not have natural resources. Kenya is endowed with natural resources. But that island was able to then unlock the gains that they could get from having a strategic location as an island. They actually control like 40% of maritime trade. We also saw the leadership adopt very friendly policies. Lower taxes. We had actually lower tariffs. This is a country that also takes like 3 hours or a day to set shop if you're opening a company. Can that happen in Kenya? We have seen that happen in Singapore. We've seen them also come up with an efficient and honest government. This is where we also have very clear legal systems, very sound legal systems, where laws are clear, they are secure, and they're efficient, and they apply to everyone. That is what investors need to see to come into this country. We sort out our legal system and ensure that it works for each and every Kenyan. We have also seen Singapore adopt, the leadership adopted, or rather they made quite some focus, they put focus on increasing the literacy levels in that country. That also played a very key role in catapulting the Singapore economy to what it is today. What are the achievements that have been made just from those drivers of economic success? We have seen Singapore, the economy was actually transformed. Today, they boast to be one of the major manufacturing and financial centers. Because of the low tariffs, the low taxes, we've seen there fewer capital restrictions, if you may, and all that. They say that it's very easy to do business in Singapore. So we've seen very strong international trading links being formed there. We have also talked about political stability and social peace. The leadership there, what they then did is ensure the first thing they sorted out was this, because of the diverse ethnic and religious background that Singapore has. They ensured that there is social peace in that country. By doing what? They focused on just ensuring that every citizen could have access to healthcare, sound healthcare. They also ensured that, of course, education is given to all. They also ensured that the population was secure when you looked at food and other kind of social amenities. Definitely, when we focus on that, we'll have an undivided society pushing for a shared vision, and you're able to then, of course, put your leadership in check as a united front. We have also seen, of course, Singapore grow into the countries in Asia with the highest per capita GDP, and I've also talked about the 40% maritime trade. Ladies and gentlemen, that forms the last slide. And for me,